Wait, what? I can do that? This is Eric Bell with Wait, What? Financial matters that matter per business and the people that own them. I'm fortunate to have Shawn Bragdon with me today, who is principal and one of the founding members of BGA Insurance. He has 30 years in the financial service industry with over 14 years with Lincoln Financial Group. He frequently speaks on a variety of advanced planning techniques and is considered an industry expert on life insurance. Shawn has a bachelor's degree in business administration from Fort Lewis College and is a member of FINRA with a Series 7, 65, and 63 license, and received his chartered life underwriter and his chartered financial consultant designations from the American College. Shawn is married to his wife Cindy, and they have 2 children. Shawn, welcome.
Thanks, Eric. Glad to be here.
Shawn, we had David McKnight on earlier, who is the author of the Power of Zero book, and he was talking about the Power of Zero, and he touched briefly on the LIRP, the Life Insurance Retirement Plan. I want to ask you, a lot of people are buying life insurance to supplement their retirement today. You have any thoughts on that?
Yeah, actually, we're selling a lot of life insurance to people that don't want or need any death benefit protection. It's pretty amazing.
So why is that?
Well, basically, it's due to the tax advantages of a permanent cash value life insurance product. Actually, in this country, there are only 3 products you can enjoy completely tax-free. You got a Roth IRA, which you can put in $6,000 a year into, but if you make over $193,000, you don't even qualify, can't even use it. You can buy a municipal bond. Municipal bond, you might get a yield around 3% today. That won't even beat inflation. The only other product is cash value life insurance. You can put in as much as you want. It grows tax-free. You can pull it out tax-free. That's the sizzle.
It's funny, when you said municipal bonds, I know the income's tax-free, but it also puts you in a different bracket in terms of provisional income and can hurt your Social Security. So really only basically 2 places, life insurance and a Roth IRA.
Absolutely. You're dead on that, Eric.
Can you get a tax deduction or use pre-tax money to buy life insurance policies right now?
Unfortunately, you cannot. So when you're putting money into a cash value life insurance policy, you're actually using after-tax money. But keep in mind, we are in a relatively low tax environment historically. The top federal tax rate today is 37%. If you go back to the tax code when it started in 1913, an average, the historical average top tax bracket, it's actually just north of 57%. So if you're putting money, pre-tax into a 401k plan, you're in essence rolling the dice to see what tax bracket you're going to be in 15, 20 years from now.
Wow. Yeah, taxes are on sale right now. Something that McKnight was talking about, too, in his book was that he thought tax rates were going to go up. What's your thoughts on tax rates?
I completely agree. In my opinion, there's no way that taxes will not go up in the future. Right now, 92% of the U.S. tax revenue is being used to pay for just 4 things. It's Medicare, Medicaid, Social Security, and the interest on the U.S. debt. It's projected in 2025 that 100% of the U.S. tax revenue will be used to pay for those 4 items. That doesn't include all the other services the government spends money on to fill your potholes on the roads, etc. So the government has a couple of choices. They're either going to increase taxes, reduce benefits, maybe they'll do both. But in my opinion, taxes are going up.
Yeah, that's usually the route they normally take. And I know in the beginning of 2026, the tax cuts that President Trump and Congress put into place are going to sunset. So it's really important that people start saving on a tax-free basis.
Absolutely.
Shawn, let me ask you this question. What type of life insurance products are people buying to supplement their retirement plans?
There's really 3 flavors. You got whole life, you got variable universal life, and you have index universal life. There are pros and cons to all 3 of those products, but in my opinion, an index universal life product is far and away the best and most flexible option for a supplement retirement plan.
Why do you say that? What's good about IULs?
Well, I think the insurance industry finally figured it out. Whole life products are expensive in my opinion. They're inflexible. You're just getting a rate of return just based on the insurance carrier's general account. Universal life products, they're not yielding very high rates today because we're in a low interest rate environment. With an index universal life product, you're getting the upside of an index like the S&P 500, but you're contractually guaranteed to never have a negative rate of return. So you get great upside potential, you got downside protection, and of course you have the tax benefits we already discussed.
So Shawn, can you tell me just a little bit more about how IUL returns are credited or how that works? Because you said you got the protection on the downside, but you got a cap, I guess, on the upside?
Yes. Yeah, I'm not going to lie to you, Eric. An index UL product is kind of confusing when you first take a look at it, but the way it works, the most commonly used index is the S&P 500. Many of these companies have multiple different index choices, but the S&P 500 is the most common, and the most common index strategy is what's known as an annual point-to-point with a cap and a floor. And a typical cap might be 12%. The typical floor is 0. And what that means in English, based on the movement of the S&P 500, your return is going to be between 0 and 12%. So if the market goes up 20%, you don't get 20 because you have a cap at 12%. But if the market goes down 20%, you're guaranteed to get a 0. Like in 2008, when the market crashed, I lost 35% of what was in my 401k plan. With an index UL product, that type of bear market, you're guaranteed to get a 0. I mean, that's a home run.
Well, and digging out of a bear market is kind of hard to do.
It is. And, that's another advantage of an index UL that a lot of people don't understand. I often ask, what's the difference between an average return or an actual return? And, if the market drops 30% and you're in a traditional equity account, you got to get a 42% return just to be at break even.
So, when I think about a 0 to 12% return, it sounds like we're kind of limiting the upside on the IUL product. Wouldn't it just be better if I maxed out a 401k plan and put some additional money into or disposable money into a brokerage account maybe or invest in real estate?
Well, I'm certainly not advocating people ignore a 401k plan, especially if the company's providing a match. That's 100% return on your money. You got to take advantage of that.
Up to the match.
Yeah, up to the match.
Yeah.
But, that 401k plan is assuming that you're alive and you're going to continue to make contributions to it. And, take, for example, a typical guy, 40-year-old guy, married with a couple of kids. He's the primary breadwinner of the family. He just got a new good job. He's contributing money to his 401k plan. And in 25 years, he's going to have a ton of money in there. His wife and him are going to have a great retirement. Well, he gets in a car wreck the next day. He's dead. Well, he no longer is going to have that retirement account. His wife is no longer going to have that retirement account. And his family's in trouble. With life insurance, it's self-completing because not only is it a great retirement plan, it has that death benefit component that is self-completing. Family's okay, kids are going to college, mortgage is paid off. And, how do you win a Super Bowl? You got to have a good offense and a good defense. Life insurance, don't forget your defense.
Right. It seems like with tax brackets going up, the 401k, the more I think about it, you're kind of in partnership with the IRS. And you don't know what tax brackets are going to be down the road. So doing something that's going to be a tax favored or tax-free distribution is even better with an IUL.
It is. And you know what? We actually have some great analytical tools that can show you how your retirement might look in the future depending on where you put your money. We have a great report. We call it a Various Financial Alternatives report, where I can show someone putting money into an equity account, a variable annuity, a 401k plan, really any type of financial retirement product, but it's taking real-world taxes and management fees into account. And what we typically see is the index universal life product will generate substantially more retirement income than all those other products unless you're getting huge returns on your 401k plan. I'm talking getting returns north of 10% to beat an index UL.
Wow. And you can't do that consistently outside the...
I haven't seen it.
Yeah. Shawn, I was going to ask you, is there any particular age group that the IUL product is best suited for?
Well, the sooner the better, certainly. It's called the magic of compound growth. The sooner you start putting money into something that you can grow tax-free, it's going to be a home run for you. But most of our business is going to be people in the range of 35 to 65. The requirements are you got to have some disposable money to put into it, and you got to go get approved with the insurance policy.
Well, 65, isn't that too old to buy an insurance policy for retirement?
Not really. I mean, you would be surprised at how many people that are in that 55 to 65 range that are putting a lot of money into an index UL policy. I mean, you're a 65-year-old guy, you got a 22-year life expectancy, normal life expectancy. You're a long-term investor. And often when you bump into that 65-year-old guy, he's got more than enough wealth to maintain his lifestyle, but he might be interested in reducing his risk exposure. You know, we had a case recently where a guy had a net worth of about $6 million. He had a lot of money in the stock market, had a lot of money in bonds. He's not going to run out of money during retirement, but he was concerned about losing principal in the stock market. I mean, we're at near all-time highs right now. He also wasn't getting good yields on his bonds because of our low interest rate environment. We simply suggested he reposition some of that money into an index UL policy. It's going to grow tax-free. It's going to limit his downside in his overall estate, and it provides a great tax-free retirement income.
Right. You know, Shawn, I wanted to ask you, when I think about insurance, I'm always worried about the cost. You know, how much does an IUL or index universal life policy cost?
Eric, that's actually a great question. I get asked that all the time, but I often ask, well, how much does a mutual fund cost? How much does a 401k cost? Well, it's not about cost. It's about how much money you want to put in for your life, to how much you want to put in for retirement. The more you put in, the more you're going to get out. And that's the way that we're going to design these types of insurance products designed for retirement.
You know, you've done some designs for me because I've come to you with clients who had a certain amount of money they wanted to have during retirement. You kind of backed into those numbers for me in the IUL product. I really appreciate that. So when you talk about proper design, can you just drill down on that for me in the audience a little bit more?
So in my opinion, there are two ways to design a permanent life insurance product. You're either designing it for low-cost death benefit protection, or you're designing it for accumulation purposes. If you try to design one policy to do both of those things, you're either overpaying or underperforming. And so when we are designing a life insurance policy, we are solving for the minimum death benefit based on the amount of premium the client is willing and able to put into the policy.
Now, so let's say, Shawn, I had $100,000, okay, and I want to put it into an IUL policy to supplement my retirement. Well, how would that design look, or how would that go if I want to put $100,000 in?
Sure. Well, first off, you wouldn't put the $100,000 into the policy in year one. That would be a bad design, because if you put $100,000 single pay premium into any permanent life insurance policy, you're going to create what's known as a modified endowment contract, also referred to as a MEC. And a modified endowment contract, you've just taken away the big advantage of cash value life insurance, because if you create a MEC, all the gains you pull out of the policy become taxable.
Wow.
So you have to avoid that modified endowment contract. Instead of you giving me $100,000 and putting it into the policy in year one, what I would recommend, hey, let's put $20,000 a year for 5 years into an index UL policy, and that would be a great design. The minimum premium that you should put into a policy designed for accumulation is you really got to do 5 premium payments or more. 5 is a great sweet spot. Anything more than 5 premium payments, you just have more retirement income.
So I would take my $100,000 and spread out over $20,000 over the next 5 years at a minimum.
Correct.
Okay.
Correct.
Okay. Now, what if I got more money in the future? Can I put more money into it? Let's say I want to put $30,000 in or $50,000 in 1 year because I had a bonus or something of that sort.
A great question. I mean, the answer is yes and no. So if we designed a policy for retirement income and we designed it to put in $20,000 a year for 5 years, you could certainly put $20,000 in year 6, year 7, year 8, year 9, etc. But you couldn't put $30,000 in, because then you would create that modified endowment contract. And it's important that we design these policies that way, because if you're solving for that minimum death benefit design, you're reducing the fees, loads, charges, and mortality costs in the policy, and your cash value is really going to grow for you.
All right, so I can keep my $20,000 amount, but I can go beyond 5 years. I can't go up to 30.
Correct.
Okay, I got you. What if I have a bad year and I can't make my premium payment? Then what happens?
Not a problem. Not a problem. So when you're designing it, I call it a max-funded design. So you're putting in a lot more money into the policy than it really needs just to maintain it. So you have a bad year, you can completely skip a premium payment. And the real nice thing with this type of design is you can catch up that premium down the road. So year 3, you have a bad year, you don't have to make that $20,000 premium payment, but year 5, 6, or 7, you can always make it back up, and it'll improve your retirement account. And that's something you can't do with a 401k plan. You can't catch it back up.
You know, a lot of people say it doesn't make sense to buy a life insurance policy for retirement because of all the fees, loads, charges in the policy. What's your response to that?
Well, in my opinion, anyone that says something like that, they don't understand the current life insurance products that are available in the marketplace, and they just haven't done the math. Most life insurance products, I would call them front-end loaded products. You got fees, loads, and charges. A lot of them are in the first few years of a policy, whereas the alternative to that would be, say, a managed account or your 401k account. Those are back-end loaded retirement products. You know, if you have a money manager on your mutual fund and he's charging you 1.25% on your mutual fund, initially that's a pretty low fee. But as time goes on, the account grows, and you keep on putting money into that managed account. Well, that 1.25% fee now becomes a really big number because you have a lot more money in that account. That's a back-end loaded retirement plan. Life insurance is the exact opposite. It's front-end loaded, and down the road, the fees, loads, and charges actually become very small if the policy is designed correctly. And we can actually show a client all the fees, loads, and charges in a policy. And the best index UL products out there, the long-term costs are about 1.25% to 1.5%. That's it.
Okay. Let's say I put money in for 10 years. I'm getting ready to retire. How do I go about pulling the money out of an IUL on a tax-favored basis or tax-free basis?
Okay, there's multiple different ways you can pull money out of a permanent life insurance policy, and there's a unique way you can pull it out of an index universal life product. The first way you pull money out is it's called a withdrawal. That is a tax-free recovery of your cost basis in the policy. You can always pull that money out completely tax-free. Now, the way we beat the IRS, when you pull the gains out of the policy, we call them a loan. And this is a loan you never have to repay back. There are multiple different types of loans in these policies. The first one I call your standard loan. That's usually the first 10 years of a policy. The insurance company is going to charge you 4% interest on that loan, but they're going to credit you 3% interest on that loan. So you have a 1% loan charge eating away some of the cash value in your policy. Still not a bad deal, but better than paying taxes. After 10 years, most of these products have what I call preferred loans, where they charge you 4% interest, they credit you 4% interest, so you have a zero-cost loan. And this interest, you're not actually paying the interest. It's all done internally in the policy. Now, what's unique to an index universal life product is you have another option, and it's called a participating loan. And this is pretty exciting because the participating loan can actually be better than that zero spread or zero cost loan I just described. And the way this works, Eric, let's say you put a bunch of money into one of these index UL policies, and down the road, you want to buy a new BMW. BMW is going to cost you $75,000. You go to the BMW dealership, they want to charge you 6% interest on that loan. You're thinking, hey, I can do better than that. Well, what you can do with your index UL policy is you could take $75,000 participating loan out of that policy. Well, what does that mean? Well, the insurance company is going to charge you 5% on that loan, but they're going to credit you whatever you achieved in your S&P 500 index strategy. So if you make 8% that year, you're making a positive 3% on your BMW. That is pretty darn cool.
Right, that is. Wow.
Now, there is a downside to that type of loan. Of course, if the market drops that year, you're going to have a negative 5% loan charge on your $75,000 loan in my example, and that does pose a little more risk for a client, but I often say risk compared to what? I mean, as I mentioned earlier, I lost 35% of what was in my 401k plan in 2008. Worst case scenario with a participating loan, you got a negative 5% loan charge on just a percentage of the money you have in that policy.
Shawn, I wanted to ask you, as you know, I'm involved with different bonds and stocks and so forth. And I've been looking at the Treasury bond yields around 2.29 on a 30-year. Bills are at, on a 6-month, about 1.96. And I know money market funds are only paying about 0.5% or maybe a little bit more. What kind of returns can you get on an IUL product?
Historically, these products have been generating a return somewhere between 6 to 8%. These products have been around for about 16, 17 years, and we actually have some of the insurance carriers that will publish the rate of return, every single premium payment that has gone into their index UL policy over this last 10, 12, 13 years. And the actual returns on some of the best products out there have actually been north of 8%. Tax-free. Tax-free,
wow.
Correct.
Wow.
So the returns have been very attractive. And as I mentioned earlier, if you're getting, 7%, for example, on an index UL, and that's a tax-free rate of return, we can show you that analytical report that compares your 401k plan getting 10%, and the index UL will just crush it. It's not even close.
I want to shift gears a little bit, Shawn. I know on a couple of my clients, we added what they call a long-term care or LTC rider. Can you talk about that?
Absolutely. That is a very popular rider that's being added to a lot of different life insurance products today. We're not even selling traditional long-term care insurance anymore, especially in the state of California. There's only a couple of carriers that even offer the product, and if you don't need long-term care, you just wasted all those premiums all those years. What we're selling is what you described, Eric, a hybrid. And a hybrid is a product that provides both long-term care protection and death benefit protection. So one way or another, it's going to pay off. And often you can add that rider to a policy. It does not increase the cost dramatically. And that death benefit can be used for long-term care protection. And it's amazing how many people don't have long-term care, and it's a big, big issue. Right now, a long-term care event is going to cost you in the range of $225,000, at least in Southern California. It's going to last 3 to 5 years. You're either going to get better or you're going to die. There's not a lot in between. If you're having to drain your IRA or drain your 401k plan to cover that cost, all of a sudden your family is not getting a legacy. Your wife or spouse might be in trouble, where for pennies on the dollar, you can have that long-term care protection on a life insurance policy.
Octogenarians are the biggest growing demographic in the United States right now, and a lot of people just have not planned at all for long-term care. I remember there was one case design that you guys had done for me. We did the accumulation policy, but also you did a life insurance policy with the bare bones cost in it to provide for long-term care.
Yeah, we're actually doing what I would call a lot of combination plans, where you might have a client that, hey, I have some money I can set aside for retirement, and that's the accumulation index UL that we've been talking about. But hey, I do need more death benefit protection than that to protect my family, and they're adding that long-term care rider. So with that type of client, we would often recommend 2 different policies. One designed purely for accumulation purposes, and one for low-cost death benefit protection with a long-term care rider, a very popular sale.
Yeah, the client loved that because it wouldn't, if they had long-term care needs, that policy was specific for that, while their accumulation policy was not being touched other than the income they were already pulling out.
Yeah, and even people that are very successful, very wealthy, that could easily afford a long-term care event are still buying these hybrid long-term care policies. It just makes financial sense.
Yes, pennies on the dollar.
Exactly.
Pennies on the dollar. Shawn, we went through a lot. I don't know if we need to talk anymore. Is there anything that you can think of that we didn't cover in regards to the LIRP, the life insurance retirement plan?
Often when I'm talking to customers about the index UL product, is they say, it sounds too good to be true. What's the catch? And the catch is, first off, you need to be reasonably healthy. Right. I mean, because to get a life insurance policy these days, you need to go through underwriting. You have to take an insurance exam. They're drawing blood. They're taking fluids. They're going to order your medical records. And so if you're uninsurable, this isn't the product for you. We've had many cases, though, where we might have a husband that is not insurable, but he then uses his wife as the insured and is still the owner of the policy and can use the policy for tax-free income. So that's one of the major drawbacks of using life insurance is you got to go through underwriting.
Okay. Anything else, Shawn, that you can think of?
Nothing that comes to mind at the moment. There are a lot of good insurance companies out there. One of the things that you might look at is diversifying a case. If you're putting a lot of money into an index UL policy for supplement retirement, you might diversify between a couple of different insurance carriers because there are index UL products. Some carriers have unique index strategies that no one else has. And by diversifying between maybe a couple of carriers, you have additional advantage of carrier diversification as well as maybe some unique index strategies.
That was one of the things I really liked about BGA Insurance was that you guys had about 67 different options, and you could diversify based on what the client's health was or needs, age, and so forth. So I like that there was no proprietary type of solution like you have some of the major carriers.
Yeah, we actually did business with 64 different insurance carriers last year, and it's our goal, and our target market, are people like you, Eric, financial advisors. And what our job is to find the very best insurance products and the very best underwriting decisions that we can find for the advisors that we're working for. And, life insurance underwriting, it is not a science, it's truly an art form. You would not believe how many cases where you have one insurance carrier that might decline a case or highly rate a case, meaning a lot more mortality costs, where we're able to pivot that case to another insurance carrier and get a standard underwriting class. It happens all the time.
Wow. Thanks for being with us, Shawn, today on Wait What? Financial matters that matter for business and the people who own them. Have a great day.
Thanks for having me, Eric.